Normally in these videos, I look at a study, provide the context of the study, and then give the answer that that study provides and share my thoughts at the end of the video. But this time, we're doing things differently. I'm going to give you the answer to the question, then the context after. Trust me, there's a good reason. Let's look at the data. By the way, if you like this kind of content, there's a button below that looks like this. Go ahead and give that a click. I'm giving you the answer first and then the context because the context will be much easier to understand when you know what I'm talking about. Go figure. Investing might be complicated. There's a very important part to investing that is easy to skip over if you're investing for yourself or unaware of the importance of it. The problem is this super important thing to understand is rather complicated, hence why I'm here. And that very important part to investing is rebalancing. The idea behind rebalancing is to make sure that an investor's portfolio maintains the proper allocation so that they can achieve their expected returns and risk. For example, if I had a goal of 50% stocks and 50% bonds in my portfolio, and stocks outperform the bonds, I might have a portfolio that has 60% stocks and 40% bonds after a couple of years. This would create a portfolio that has a different risk characteristic than a 50-50 portfolio. To correct this, you would have to sell stocks and buy bonds to get your portfolio back to a 50-50 allocation. So, the question for many portfolio managers and individuals alike is, what is the most effective way to rebalance? Vanguard's study posted in June of 2022 and linked below tries to answer this. They answer the question by saying, we find that the optimal rebalancing methods are neither too frequent, such as monthly or quarterly, nor too infrequent, such as rebalancing only every 2 years. Implementing an annual rebalancing is optimal for investors who don't participate in tax loss harvesting or for whom maintaining tight tracking to their benchmark portfolio is not a concern. To me, this means if you fall into the specific group of people that this study represents, you should rebalance your portfolio annually. But how do you know if you are that group of people, and what are their methods of getting to this answer? Now, let's actually look at the data. It's important to start with understanding what risk characteristics and expected returns different portfolios can create. Take a look at Figure 2 from Vanguard's article. This shows the risk-return characteristics of a 100% bond portfolio on the left, with the highest earning year being a 32.6% return and the lowest being a negative 8.1% return, with an average annualized return of just 5.3%. Fun fact, this article came out before bonds had one of their worst years ever in 2022, with the Vanguard Total Bond Market ETF being down 13.13% on a total return basis. Back to the point. On the right side, you can see that a portfolio that's invested 100% into stocks ranges from being down 43% to being up 54%, with an average return of around 10.6%. The less stocks you own, the less your expected annual return is, but also the smaller the variance of upside and downside risk that you take on. This is what we often refer to as risk tolerance. If you're only willing to accept an 18% downturn, then you would be looking at a portfolio of 40% stocks and 60% bonds, and can potentially expect a return of 7.8% long term. If you want a higher return than 7.8%, then you have to accept higher risk. Vanguard looked at several ways to rebalance portfolios to keep the expected risk-return efficiency. But before that, comment below what your portfolio looks like. Is it 70% stocks, 30% bonds, or are you fully invested in the market with 100% stock exposure? Let me know below in the comments. The results that Vanguard found were fairly interesting. Look at their Figure 6, which shows the calendar-based rebalancing. You can see that the worst performing methods were rebalancing daily and never rebalancing at all. The best method is annually, but there's very little difference between the quarterly rebalancing through the 2.5-year rebalance. This is encouraging for the lazier investors. Just keep up with it at some point, and in 2.5 years, you won't be too far off from your investment goals. So, what can a data-driven investor do with this information? If you're managing your own portfolio or someone is managing the portfolio for you, make sure that you know what risk tolerance you're willing to accept and what potential outcomes that creates. Then, my recommendation would be to set rules around how and when you will rebalance. We can tell from the study that the most often you may want to rebalance is quarterly, and the least often you would want to rebalance is every 2.5 years. Set a few guidelines for yourself to know when you will and how you will rebalance. If you do this, you will optimally track the benchmarks that you set out for yourself with minimal tracking error from your goals. If you would like to decrease your tracking error, then rebalance more often, but know that the more that you transact, the more cost you'll have in your portfolio due to trading cost. Now, if you are your own investor, I highly recommend that you check out this video so you know the common pitfalls of many individual investors and you can avoid what is called the behavior gap. Speaking of the behavior gap, that's what the guys on our podcast talked about. So you should also check out the Market Moment podcast.